All right, hello and welcome. We've been discussing the weighted average cost of capital for a considerable amount of time now. And now what we're moving into is this notion of the marginal cost of capital. Now, from your economics background, you remember what marginal is. If you remember marginal, it's of one more. So when we look at our cost of capital, our marginal cost of capital, right, we have to look at that, the cost of capital for each additional dollar borrowed, okay? Now, to clarify this is that whenever we are looking at borrowing money, what types of people typically will get the lower interest rates? They're going to be the people with money, so wealthier people and better credit risk people are going to have lower interest rates, okay? Now, let's say that they borrow everything they can at that lower interest rate and they run out of room from that credit line from their bank. What could they do next? Well, they're probably going to pull out their credit card, right? And what's their credit card going to have? Is that going to have a higher interest rate? Yes. And as you keep borrowing more and more and more, we're going to have a higher cost of capital, okay? So that's what we're referring to as our marginal cost of capital. So what we're looking at here is that as we borrow more money, as my company borrows more and more and more money, we face a higher interest rate, okay? So we're going to refer to this as our MCC, marginal cost of capital schedule. Okay, and this is essentially going to be a graph where we graph out each of our individual marginal costs of capital. Okay, so we will start our graph here by looking at our company. So let's say that my company can borrow $500,000. Okay, so on our horizontal axis is the amount borrowed, is dollars. Our vertical axis is the rate of return, the interest rate that we can borrow at. Let's say for that first $500,000 is that I am able to borrow at, say, 4%, okay? And so that is at the first $500,000. So I can borrow up to $500,000 at 4%, okay? And then let's say for the next $500,000 up to $1 million, right? The difference from the $500,000 to the million is $500,000. Okay, so let's say that from that difference, from 500,000 across to 1 million, okay, let's say that that amount is at 6%, okay? So where am I going to borrow money first? I'm going to borrow money first at 4%, and when I run that out, I'm going to start borrowing at 6%, okay? Now let's say I have other projects that have other funds available for, and let's say that I can borrow up to $1.2 million. Okay, and that interest rate is going to be at 8%. These points, so you can see right here at $500,000 at 1 million and 1.2 million, these are what we refer to as break points. They are a point when we borrow above that point, the break point, the interest rate rises, right? It picks up to a higher interest rate, okay? And then the point after 1.2 million, our interest rate is going to rise. Give me a number. Let's say it at this point is that my creditors think that I'm becoming well too more risky, and let's say that I'm going to be borrowing at 12% from this amount up to there on out, okay? And that's the point there. So the point we're looking at here is if I have zero borrowing, is that I want to start borrowing, I can borrow at 4%, okay? And I can keep borrowing up until my interest rates keep on rising, okay? So that brings up the question, why are the interest rates higher when I borrow more? Simply, it means I'm becoming more leveraged, right? As I'm more leveraged, that means that I have a lower ability to pay back my debt, okay? If something bad happens, right, it's going to be harder and harder for me to pay back my debt. So with me being more risky for borrowing more, that is why we have that difference in that amount down there. Okay, is because that is compensation for the lenders, for me being a less good credit risk. Okay, so this was the introduction into our marginal cost of capital. Next, we are going to talk about our investment opportunity set. Basically, because we have, this is the amount what we're looking at. Say I'm a CFO, I'm looking at my marginal cost of capital, and I'm wanting to figure out, hey, what are my borrowing costs going to be? And then I'm going to look at next is the investment opportunity set, and this is going to be the projects that I can do. And then following that, we're going to take those two things together and we're going to combine them. And that's going to tell us what basic projects we are interested in funding and actually getting done.